zero real interest rates or negative real interest rates are too stimulative. You know, it's like
we're
injecting. We're at zero real in terms of real interest rates. And it's been negative for so long, and that puts too much stimulus in the economy. And like anything, if you take too many steroid shots, bad things happen. If you eat too much sugar, bad things happen. So we've got to get off the sugar high. We've got to go back to a normal economy with normal rates where businesses, part of the big problem is 14% of the S&P 1500 companies, in the last 3 years, their EBIT doesn't cover their debt service. Not their debt. They couldn't pay off their debt. They can't even service their debt. So we have all these zombie companies, and we need them to go away.
Is that going to be a crash?
Well, look, I don't think it's a crash.
A bubble burst, look, the corporate debt?
When we were together last time, I came on with Melissa a couple weeks ago, and I talked about it's not a crash like 40 to 50% tomorrow. Everyone's worried about 2008 again. We don't have the leverage in the system to have 2008. What we're more like is 2000, 2001, 2002. 2000, the tech bubble, the tech wreck, was only down 9%. I think we'll be down single digits this year. The next year, we had a shallow recession, first quarter negative, second quarter positive, third quarter negative, full year 1%. We had a down 14 year. It was 2002 when the debt bubble broke, Enron, WorldCom, and I think that's the big problem. All this corporate debt will break in.
When you were here, I believe it was in October, you said that you thought stocks were 40 to 50% above fair value.
Yes.
A lot has happened since then.
Yes.
How much above fair value do you think they are today?
30 to 40. We're down about 10 since then, so about 30
so
to 40
you still
more.
believe?
We still have a long ways to go. So the Dow is down 570 points today.
Yeah.
There's more downside here.
Oh, lots more.
Lots more.
And I think it's over a 2-year period. I think we're going to go down for a long time, just like 01, 02. And the difference between a bull market and a bear market is a market that goes down most days, but goes up a lot on good news or perceived good news. Yesterday was perceived good news.
Well, and like Monday.
And like Monday, right?
Like Monday.
But it's not really good news. It's just the perception. Bull markets go up most days, but go down a lot on bad news or perceived bad news. I think we shifted on January 26th this year from bull market trend to bear market trend. And it's going to take a while to get back to normal.
Are you short this market?
We are hedged because we always think there's opportunity. So we're about 40% net long. So we've got longs and shorts, and we're long things like, you know, utilities and consumer staples and healthcare.
So
Healthcare had a bad
defensive tilt.
Yes, and we're short the FANGs. I mean, I don't like companies that trade at triple-digit PEs. I never have. I'm a value guy. Now I'm not always right. Don't get me wrong.
Facebook is trading at 18 times.
Next year, I always look at the last 12 months. That's the only earnings we ever know. Everyone talks about future earnings. They look at this year and say, oh, we're up 23%, so we'll be up 28% next year. There's no way earnings are going to be up 28% next year. So I don't look at the forward earnings. I look at the current 12-month earnings.
Let's talk. You talked about taking too many steroids, eating too much sugar. You like a group of stocks you call the carbs.
Yes.
You should generally stay away from too many carbs, I had found. But what are the carbs and why do you like them?
Look, I totally believe in the keto diet and the paleo diet. I was kind of poking fun a little bit a few months ago when I was training for a marathon, and hey, it was the first time I could eat carbs in a long time. But CARB stands for China, Argentina, Russia, Brazil, South Korea. So it's emerging markets. They've already sold off. They're actually really cheap. And look, if we go into a global slowdown, I'm not saying that they're going to rip upwards, but I do think if you can look around the world and you want to buy equities, if you're really set on buying equities, you don't want to hold cash, you don't want to hold bonds, you don't want to hold Bitcoin, then you should own the things that are cheaper. And emerging markets are as cheap as they've been, except at the depths of the crisis in 09.
And you think Bitcoin's getting to a bottom?
Look, I think
you think Bitcoin's going to outperform the S&P over the next decade,
Over the next decade. We issued the crypto challenge, the Morgan Creek Digital crypto challenge yesterday. So we're issuing $1 million challenge like the Buffett bet.
I wish I could take the other side of that, but $1 million is a little.
You don't have to put up half. Both sides put up half, and we fund it in advance.
Just half, Kelly.
Well,
and look, we think over the next decade, we think U.S. equity is going to have basically no return. We think crypto is going to have a really great return. We are so early in this technological wave that is crypto. And the price is very volatile. But we're talking about technology like iOS and Android.
Everyone who listened to this 6 months ago has gotten creamed in crypto.
Well, look, things are volatile, right? NVIDIA is down 50% in the last 45 days. 45 days.
I know.
And people were buying
NVIDIA. They tried to say, don't make us part of this.
You know,
we know you want the
days.
graphics chips.
But look, volatility is real. And all I'm saying is that for investors who want an asymmetric return profile over the next decade, you take 1, 2, 3, 4% of your portfolio, you put it in crypto assets, I think it's going to dramatically outperform.